Hello and welcome. You're watching KYC, Know Your Company. Here it's a show which is designed to give the regular investor powerful, actionable insights into a single listed company daily. Now, today we're going to zoom in on PDS Limited. It's a very interesting play with regard to textiles. In terms of what the company does, well, it manufactures, it's into trading of garments and also designs and develops as well as helps in marketing of products and consumer products is broadly what it deals in, more so textiles and garments. The sourcing and distribution of ready-made garments is what the company does. It works with leading retailers. Let's probably put some names there as well, as Sainsbury, a Ted Baker. It also works with a Primark, a Walmart, a Tesco, a Kohl. So you have all of these global giants with which PDS works with. It manufactures products for these players and provides them with product. These are largely the products that they deal in, at least for the moment: menswear, women's wear, children's wear and essential wear. That's broadly the way they categorize their products. In terms of manufacturing facilities, they have three. They have two in Bangladesh, one in Sri Lanka. The two facilities in Bangladesh are fairly large. In fact, nearly 80% of their facilities are based in Bangladesh. So sourcing largely happens from there. The clientele, of course, as I did mention, is spread across companies, but also across geographies. You have North America, Europe, UK, as well as Asia as key geographies that the company deals in. Even the split in terms of geography is more skewed towards a UK and a Europe than towards a North America. But nonetheless, given that tariffs is really the news of the day, we'll obviously want to understand what the impact of this is on the company as well, in terms of what the US tariff impact on the company is. That's the split with regard to geography. If you can see, nearly 72% coming from UK and Europe, just about 12, maybe 16% now skewed towards North America, 68% from UK, Europe, and thereafter the balance is around 15 to 16% coming from Asia at this point. So that's how the company is split up. So this 16% largely will get impacted basis the overnight news that we got. That's how it looks like in terms of the pie chart. A bulk of that coming from UK and Europe, right? Currently, the order book is quite high. It's at around $425 million dollars. So around $500,000 worth of order book, which it sits on at the end of 9 months FY25. So that's the sum and substance, frankly, of the company. Let's try and now break down the numbers and let's try and zoom into the metrics we'll be looking at. And in that sense, let's quickly pull the metrics up. We'll look at the income statement, balance sheet, cash flow, and the return ratios. And thereafter, we'll look at shareholding, street cred, valuation, as well as street coverage. It's interesting from a sense that it's a smaller company in relative terms, as we always do in KYC, just a 6,000 crore company in market capitalization. And joining me now is Mahima Vajrajani, who's going to help us break the company down. Welcome, Mahima. Busy day for you. You've been on screen pretty much all through the day. So thank you for this. But let's quickly break down the income statement.
Right. Pretty strong numbers where, all the four metrics are concerned. Revenue has seen overall an 18% 3-year CAGR. 9 months, it stood at around 9,000 odd crores, which was around 10,300 odd crores in FY24. EBITDA overall has seen again an 18% 3-year CAGR, which stood at around 318 odd crore in 9 months FY25. Margins have slightly come down from 3.8% to 3.5% for 9 months FY25, but we'll have to wait and watch out for as to how Q4 pans out and how overall margins pan out in FY25. Net profit overall stands at 167 crore in 9 months FY25, which is lower than that of FY24, which stood at around 203 crore, but we'll have to again see as to how Q4 pans out. But overall 3-year net profit CAGR has been 20%. So overall 3-year CAGR for all of these metrics are strong, which is why we've given a thumbs up for this counter. In terms of the metric that is gross merchandise value is important for something like a PDS, which has increased around 31% YOY, where 9 months FY25 performance is concerned. Overall top line growth is also at 26%. EBITDA growth at 14%. Order book, as Harsh earlier also mentioned, stood at $425 million, and this is a growth of 11% year on year. And in terms of segmental performance, well, there are two different segments where the revenue comes from for something like a PDS, which is sourcing, where around 94% of the revenue comes from sourcing, and second is manufacturing, where around 5.7% revenue comes from manufacturing, and others is around 0.3%. In terms of geography-wise split, as Harsh earlier mentioned, the UK overall geographical split has come down to around 34% from 40% earlier. Europe has remained within that range of 34%. North America has increased to 16% from 12%, and if it it is increased as compared to last year by around 4%. We'll have to wait and watch out for as to how this percentage now either improves or decreases because of the tariff impact. Asia and Middle East is around 13% of the counter, and in terms of category-wise split, menwear is 37% of the overall sales, followed by women, which is also at 37%. Children wear is around 21%, and essentials and others is at around 5%. So this is the revenue category-wise breakup as well. So this is the overall view as to how P&L and income statement metrics are concerned, and it's definitely a thumbs up where all the 4 metrics are concerned. Harsh?
Yeah, absolutely. So strong in that sense in terms of the overall numbers. But let's look at the balance sheet, in fact, because this one's an interesting one. And Mahima, you have views on this as well. So I'd like you to chime in with regard to the views. In that sense, your net worth stands at around 1,600 odd crore. But you look at your gross borrowing, and this is the long-term gross borrowing which we're currently talking about. Around 120 odd crore. Looks small, right? But the short-term debt is what is really large. Of course, it sits on a healthy cash and bank balance as well. But the short-term debt is extremely large. Now, to contextualize, it's likely that some of that debt has been taken up to lock in inventory that the company sits on. But also try and understand that given the kind of balance sheet size, that's a large amount of debt which is payable in the short term. It also has cash balances to take care of that. So that also not a concern. But just the number looks large. Mahima, you want to contextualize that?
Right, absolutely. So as you rightly mentioned, the short-term debt could be higher because of, and this is first half of FY25. And generally, textile companies or garment companies, build up inventory ahead of festive season. And because of that, they do take short-term debt, and which is why the short-term debt in the first half generally goes higher. But we'll have to, of course, ask the management as to how debt has panned out so far post first half of FY25. Overall, in terms of net debt to equity, it stands at around 0.21 times, which is not a problem right now. And net debt to EBITDA also stands at around 0.8 times. So that's the view where, balance sheet is concerned. And we've taken a conservative approach because short-term debt is higher and given it a neutral rating. In terms of cash flow, cash flow from operations have turned negative in the first half of FY25 to around 32 odd crores, which was 22 crores positive earlier. And in terms of net cash flow position, however, that has improved, which was a negative 328 crore in first half of FY24, which has improved to around 268 crore in first half of 25. So just taking a conservative approach here again, because the net cash flow from operation right now is negative, we've given it a neutral rating. But of course, we'll have to wait and watch out for as to how overall FY25 pans out and whether this negative 32 crore turns into a positive number or not. So that is why just because of that negative 32 crore number in first half of FY25, we've given it a neutral rating for now. But in terms of return ratios, they are healthy but on a decreasing trend.
Yeah, and that's the other concern, right? Whether CAPEX is really creating that overhang with regard to return ratios or otherwise. But point being that return ratios are on a declining trend. They were at the higher end of the band over the last couple of years. But a 22% return ratio, not bad at all in a space which is capital intensive in that sense. So we'll continue with a neutral on this. We're being a little harsh here, but we're going to continue with a neutral on this. And the return on equity though, when you're looking at that number, it's come off significantly. And that's one of the major reasons why we hold a neutral stance on this one, that the ROE number is just about 13%. The trailing 12 months in terms of ROC is sitting at 25%. So that's the other angle to look at this in, and broadly that metric stands decently in terms of its shape compared to the 22% FY24 number. But you want to take us through shareholding?
Right. So, in terms of shareholding, well, definitely a well-held company in terms of how things have panned out for the counter. Promoter holdings has gone down, but it still stands at around 61.5%, which is well above the regulatory requirement, and which is why it's a strongly held company. And it's overall also from a longer term view also, it's just come down from 65 to 61, which is not a problem. FIs have increased their stake from 3.4 to 5.1%. DIs have significantly gone up and bought this particular counter. It's gone up from 0.6 to around 5.7%. And overall, public holding, of course, has slightly come down. That public holding has probably moved to the DI space, where around 20, which was around 30 odd percent, which has come down to 27 odd percent. But overall, FIs are buying, DIs also investing in the counter, and promoters have slightly reduced their stake, but well above the regulatory mark, which is why it's a complete thumbs up where shareholding pattern is concerned.
Yeah, complete thumbs up. 2-3 things to be kept in mind. Sorry, I'll chime in here a little bit. So one is the shareholding has reduced because of thin selling by the promoter, yes, but the other piece is also because of an equity raise which happened first half of this year. So something to be kept in mind. The other piece is with regard to both FIIs and DIIs, why their stake has gone up. We've had some exits, especially on the FII account. DIIs, of course, in terms of significant DIIs, you have a couple of mutual funds which have bought ICICI Prudential, ELSS Tax Saver Fund, and Aditya Birla Sun Life Insurance. Both of those as DIIs have bought. You have, in terms of public holding, and this is very, very crucial according to me, you have a Mukul Agarwal which holds this company. You have Vallabh Bhansali who holds this company. Inam has a stake as well. So you have several marquee investors, but their holding also is on a slightly reducing trend line. So Mukul Agarwal at his peak was holding 2.75%, currently holds just 2.5%. Vallabh Bhansali also at 1.8, now at 1.1. So something to be kept in mind as to how the shareholding pattern is evolving. Of course, we give it a thumbs up because the promoters continue to have very good skin in the game. But outside of that, these are some other aspects which you might want to keep in mind.
Absolutely.
So yeah, that. You want to go ahead?
Yeah, sure. So where street cred is concerned, well, this is probably the only metrics where we've given it a thumbs down, because overall stock performance does not look very attractive. 6 months, it's down by about 15.7 odd percent. Year to date, the stock is down by about 27 odd percent. And of course, this is on the back of markets also facing the pressure in terms of in the past 6 months. Overall, in terms of 1 year, the stock is down about 14.5 odd percent, and 5 years return also. If we see, the stock has given returns of only 33 odd percent, which is why we've given it a thumbs down, because overall the stock has not been performing well. And even in terms of valuations, Harsh, you may want to take that. Valuations for the counter definitely are expensive, and we're seeing that the decline, however steep, but the P ratio, as per what Bloomberg suggests, is going to compress. So
you're going to see better earnings visibility over the next year or two. At least that's what analysts seem to be suggesting. And there are just 2 analysts which actually cover the counter. Right. So that's the other piece that you'll want to keep in mind. That there's no significant coverage per se. So a neutral on both those counts actually, Mahima. But you want to take us through the valuation as to what the growth expectation is for the company, because that will hold the key to the way in which this valuation picture evolves, if you do have a perspective on that.
Right, for sure. Like we've seen that the 3-year CAGR for the company has been around 18% where top line is concerned. So if you continue to see that CAGR growth going ahead also, compared to that, we're seeing that there will be a steep decline in valuation. So at some given point of time, if this continues, valuations might become attractive over a period of time, but that will happen 2 years down the line, because next year we're expecting the PE to go down from 39 to 34 only. So not next year for sure, as per what Bloomberg estimates suggest, of course.
Fair.
And we'll have to wait and watch out for if that growth is beyond that 18% growth CAGR and see as to how valuations pan out there.
Correct. So, so that's the larger expectation. Let's quickly sum it up actually in terms of all the metrics, and that's how it really stacks up. The balance sheet in terms of short-term debt, we spoke about cash flows, return ratios, all of these aspects we actually covered. Let's talk about shareholding, street cred, valuation picture, and street coverage. So that kind of caps it off in terms of the rating itself, and we're left with around 4.5 on 8 on this one, PDS Limited. Of course, based out of India, manufacturing in various locations and selling largely to Europe as well as US. Let me welcome on board Mr. Sanjay Jain, Group CEO at PDS Limited. Welcome, Mr. Jain. You know, great talking to you. I'm Harsh, and you know, very quickly wanting your take, because it will the current need of the hour is to understand how US evolves with tariffs and what's the impact on you. So before I go on to the larger business, let me talk about the risks emanating from tariffs on your business.
Hi, Harsh. Morning.
Hi,
I think all of us have woken up to a very exciting morning today. So I think for us, what is unfolding seems to be, kind of leading to more opportunities ahead. As you know, the way we have organized a model, we are relatively asset light. For me, what is important is to serve the customer from the best available factory in the world. So having said that, today, US is about 15% of our total sales. So, if I talk about as on date today, it's just a relatively much smaller percentage. And our own manufacturing, what we sell to US market is closer to about 20% or so. So to that extent, the impact on an immediate basis, is not anything very significant. But given our model, given the fact that we are serving our customers from various markets, for example, we believe in the tariff situation that is unfolding, Turkey could be a beneficiary, and Egypt could be a beneficiary. So PDS already has a strong footprint in Turkey. It has recently invested into developing resources who in turn are in touch with factories in Egypt and Latin America. So we tend to benefit from that. And lastly, I believe while there is additional tariff on India as well, but the tariff on some other, exporting nations like China or, Myanmar, etc., have actually got much higher tariffs coming their way. So to that extent, exports from India, should benefit. And PDS has recently done an acquisition of majority stake in a factory in India, plus have deployed more resources in India to enable more exports from India, from Egypt, from Turkey. So net, from the present metrics, not much impact. As things unfold, we should be a beneficiary of whatever is happening.
Sanjay, just to follow up on that, hi Mahima also joining in. You said that this could possibly have a positive impact on PDS. Right now you said almost 15% of your revenue comes from USA. Do you expect that percentage to significantly go up in the next 1 or 2 years? And if yes, how will that pan out? Overall from 15%, where will you be at?
Yeah, hi Mahima. We have got a strategy rolled out whereby gradually we see US to be somewhere closer to 30% of our total sales in about 2 to 3 years from now. And when we are trying to fulfill those sales, we concurrently went ahead and invested into resources in Egypt, in Latin America, as I just said, as part of the previous question. And these geographies, should be in a much better position to cater to demand coming in from US. So as a result, we've been very well prepared to capture this anticipated 30% of top line. So, and also I just said that given our model, given our asset light model, given our agility to quickly contract factories across the world, we should be in a very good position to realign and cater to this, changing dynamics in the world. But realignment is in future. Even the last 18 months investments into Egypt, into Latin America, into India, that gives us the confidence that we should be the beneficiary from this, unfolding of tariffs.
Understood. Okay. So give us context with regard to how certain is the order book and how certain is visibility in terms of clients. How long are contracts, and therefore is there a risk in that sense of losing clients at some point? And how does pricing work in an environment like this? Do you expect an impact on pricing? Because across the board there are tariffs. There are 180 countries where tariffs have been levied. Do you believe that there's going to be a change in pricing?
So I think firstly, in the 9 months up to December 24, we have had 20% plus growth. And as things stand today, we've just entered the new financial year. Our order book is closer to 600 million US dollar, which is almost like, close to 25% plus up for the same period last year. So we've actually entered the year on a stronger footing. So that gives us the confidence that maintaining growth in the coming year is a distinct possibility. And in terms of, we've got a very well diversified customer base. We take care that no single customer should constitute a very large proportion. Our customer base is very well diversified across reputed and credit-worthy customers. For example, if I talk about UK as a market, just as an example, Primark, Tesco, Next, Sainsbury, Asda, these are some of the large accounts, and these are pretty much stable companies. And if at all there is any turmoil, they should be the one who should be benefiting from this. And these relationships have been built over years. In fact, in US as well, as we are wanting to, expedite more and more sales into US, the relationships are with Walmart, with Kohl's, with Costco, with Target, with TJ Maxx. So again, I think these are very stable customers. As I said, relationship built over years. So therefore, while the nature of the businesses that you are discussing with customers for the coming 2-3 seasons ahead, but the past relationship, the track record of service delivery, the track record of catering to the design gives us the confidence that the business is here to stay and grow as well. And talking in terms of pricing power, I think if at all, given the tariffs across geographies, the manufacturers in some geographies may come under pressure. And if PDS is getting almost 80% plus of its sales from UK and Europe, that means I am actually in a good position to fill those factories, which are otherwise, getting impacted, if at all, by more sales to US. So that should give me some leverage in terms of pricing power when it comes to sourcing from factories.
Okay. Mr. Jain, you also talked about a recent acquisition, and that is the Knit Gallery India Private Limited, and this specializes in baby clothing. I want to understand as to, how, this entire acquisition will play out. How much will it add to your top line? From a longer term perspective, if you can give us a view, let's say 2 years down the line.
I think, Mahima, today's event probably give me the best position to explain the strategic rationale of this acquisition. We touched upon tariffs coming on some existing exporting nations, and I talked about India to some extent having relatively much lower tariff as compared to other nations. From a global sourcing strategy perspective of a retailer, they look upon India as a country from where they want to source more. And as a result, we went ahead and did the acquisition of a company which is into knits, into baby wear, doing circa 40 million US dollar, very blue chip set of customer base like an Unsting Family, TJ Maxx or a Primark. So to that extent, this investment in a facility in India gives me strong credentials to showcase my strength to global retailers that I know what it takes to manufacture in India. So I think, therefore, this acquisition should be seen in the context that when we are doing our own manufacturing of about 90 million in Bangladesh, I'm actually exporting circa 800 million plus out of Bangladesh. If I have a manufacturing of $15 million of a facility in Sri Lanka that I own, I facilitate $95 million of exports from my partner factories. So therefore, if this is about 40 million acquisition top line in India, I think it should unfold into slowly PDS getting into a position of at least $500 million of exports coming out of India from the partner factories. So that's the strategic rationale of the acquisition we have done with good customer base.
Right. Mr. Jain, so how should we look at the business? Can we expect your top line to double in the next 3 years? Is that very, very reasonable to expect, and will you be able to maintain the margins that you do?
Harsh, we've said about close to 18 months back that we are aspiring towards 555, which is like in 5 years. And I think 18 months have passed in the journey. We should be 5 billion GMV, which means about 3.5 billion top line. And we are at about 1.8 billion top line. So we're on that track, to get to that 3.5 billion top line. And we've grown 20% in the first 9 months of last year. Our order books are good, as I just mentioned. So we feel very positive that we are progressing well en route to get to what we aspired for 555. So I think we feel confident. I think profitable execution would be key. But in terms of our business model, the way we are organized, I think the order inflow has been steady and it has been positive.
And debt levels will get maintained, Mr. Jain? Sorry, very, very quickly, because we are running short of time.
Yeah, we've been having net debt to EBITDA on a comfortable level. I think our aspiration would be to maintain at that level. Yeah.
Fair point. Thank you so much, Mr. Jain, for coming and speaking with us. Super helpful in understanding PDS Limited. Very interesting company operating, of course, from India, but playing the Europe and US consumption theme.
Absolutely.
So on a day like this, great to get those views. But with that, completely out of time on this edition of the show. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.